the InvestSense market commentary for the fourth week of January 2026, and by and large a fairly quiet week despite some of the headlines. It started off the end of last week with more aggressive stance from President Trump about Greenland, but over the weekend and at Davos he seemed to capitulate. What's become known as the taco trade came to the fore and markets calmed down a little bit with the US and Nasdaq up a couple of percent. But actually there's still elements of that rotation trade with global small caps outside of the US up by another 4%, which is reasonably significant, and emerging markets, including China, up by 4%. But underlying the fact that there's probably still some uncertainty there, gold was up yet another 8%. Breaching the $5,000 barrier. Another little milestone was BHP, a beneficiary of commodity prices, which became the largest local company, surpassing CBA during the last week. And obviously iron ore prices, along with other commodities, have been very strong so far this year. So there is a sense that this rotation trade, which includes emerging markets, commodities, etc., is still underway. But probably the biggest event this week was just a few hours ago, which was the Australian fourth quarter CPI print, which came out a little bit above expectations, taking the number on a trimmed mean basis to 0.9%, which was, as I said, just a little bit above what the RBA was expecting and what most economies were expecting. So what you see there is a little bit down from the previous quarter, but still stubbornly high, being driven by the roll-off of energy subsidies and housing costs, as well as some cost pressures across other sectors like healthcare, which a lot of people are probably feeling. But perhaps the kind of maybe not silver lining, but not such bad news is that a lot of this has already been priced in. So the chance of a hike at the next Fed rate meeting, which will be on February the 3rd, getting up to 70%. But it's the one after that where maybe expectations are firming a little bit. But if you look at how rate expectations changed on the chart, the difference between those two little lines going out the rest of this year is only 5 basis points. So basically that means that what we've seen so far in rate increases for the local market, since October really, has about 1% or so has been priced in, and the market doesn't see a whole lot more than that, which is maybe not such bad news for mortgage holders. But where you have also seen a bit of movement is in currency markets. So you saw a big jump up the last few days, about 4 or 5% in the Aussie dollar versus the US dollar. But actually, it has been stronger relative to other countries, but it's really, if you look at this, the DXY index, which is against a basket of currencies, you've seen a similar drop in the value of the US dollar. So it is a more generalized thing. Another thing just to note, which was significant in the last week, is there's a lot going on in Japan, and there's some circumspection about whether the fiscal policies can be coherent with the debt burden that they have over there, and whether that's coherent with monetary policy as well. Now, a little bit of a tremor out there is that the yen also strengthened by more than other currencies. And when you see the yen strengthen a lot, sometimes that can be a precursor to instability in global markets. So just something to watch out for. And a missed opportunity perhaps, because last night we spoke with Andrew Hunt of Hunt Economics. Andrew's called out these two opposing forces. On the one hand, you have these global capital flows and the People's Bank of China becoming increasingly influential. And that's maybe a potential fault line, and behind this dollar weakness, and a potential threat for treasuries, although you haven't seen yields rise too much there yet. But something he's saying you should watch out for. At the other end of the scale, he's calling out basically a credit boom, which seems to be gathering pace, a lot of it going into AI infrastructure. And behind that, probably a willingness by the administration to keep this credit boom going, at least up until the midterm elections. So with that in mind and those opposing forces, he's saying, don't make too many heroic bets. But where he ends up is actually, if you can find places that are less volatile, and it does involve this rotation trade to a large extent, and also local government bonds, maybe those are the places that you hide out a little bit, but don't make too many big macro calls. So we think at the moment Andrew is someone worth listening to, as we always do. But in particular, he's lived through a few of these booms. He's not calling an end to it quite yet, but he's also tended to be quite prescient when there's these things happening beneath the surface that people don't quite understand. For instance, quantitative easing, the whole concept of that more than a decade ago, and then we had the repo markets, and there's been a few things like that that have, with hindsight, turned out to be influential. So our ears pricked up a little bit when he talked about the influence of the People's Bank of China in the plumbing of the monetary world at the moment. And so that's maybe something to watch out for, and tune into the video this week if that's of further interest. Look forward to talking next week. Thank you.